expected, but they were all expecting it in June. Nobody expected the Reserve Bank of India, to host a monetary policy committee meeting, out of the cycle and
Yeah.
take this decision. But thinking about it, what could have led to this change, in just around a month's time? I feel there were two, three factors. One is, of course, the FOMC meeting, as you highlighted. The markets in the US, the swaps markets in the US, they are expecting the FOMC to raise rates by 50 basis points in each of the next 3 or 4 meetings. So that's
Yeah.
quite huge. The RBI probably did not want to play catch up with the US Federal Reserve, and also the rate differential between Indian rates and the US rates would have been quite large. The US dollar is strengthening. The rupee has so far been stable, but if the rate differential widens, it could have been some crazy moves for the rupee. The second reason I think is that the April print for retail inflation, for consumer price inflation, is going to be the bouncer which you are talking about. It could, some economists I spoke to after this, they said it could be even high as 8%, 7.5 to 8%. The March number was 6.9%. So clearly, the RBI's own assessment of 5.7% average inflation for this current fiscal year, that also
Yeah.
has to be thrown out of the window. The third factor which the governor was about food inflation. And well, some people really don't buy this argument about food inflation, but remember a couple of things. There are certain studies which I think talk about food inflation playing a big role in anchoring inflation expectations.
Hmm.
A and B, food inflation is clearly rising. See, now increasingly we are seeing reports of the wheat yield in North India falling by, some people say, by as much as 25% because of this unseasonal heat wave. That has already started putting pressure on wheat prices, and
Yeah.
then that Indonesia's palm oil export ban, that has also started putting pressure on edible oil prices, which were anyway, at record highs. So I think, taking all these factors into consideration, the RBI felt justified, to go in for an out of turn rate hike on the day of the LIC IPO, no less.
Okay. But how bad is it? A 40 basis points rate hike. I mean, the way RBI had sort of, cut the repo rates by about 250 basis points in step 2019, and this was in order to revive the economy. And now that they're trying to sort of unwind that, the way the markets are reacting, is it justified? Is it expected?
Well, I think, see, the markets were anyway expecting a rate hike, but as I said,
Exactly.
they were probably looking at it from June and not so early. So maybe it's a knee-jerk reaction that
Yeah.
we saw 1,400 point fall in the Sensex. But as I said, the conditions are building up for a rise in for a sharp rise and a continued rise in inflation. The RBI is likely to miss, the monetary policy committee is likely to miss its target of keeping the lid on inflation under 6%. If inflation exceeds 6% for 3 quarters in a row, or falls below 2% for 3 quarters in a row, then they are answerable to the government and parliament. They have to give a written explanation.
Yeah. Yeah.
So, a rate hike, I would think, was always on the cards. And while, the RBI, the governor did talk about it being accommodative, I really don't buy into that, because what this clearly signals is that more rate hikes are around the corner. Uh, uh, you know, uh, Before the pandemic, it was around 5.15%, and even at that time, I think it was neutral to accommodative or something like that. So at least another 75 bips of rate hikes, I think, is on the cards, and over the next, two three meetings.
But one big question that's riding on everybody's mind is why now, when the LIC IPO has just opened up, and why would this announcement come by and hit the sentiment, hurt the sentiment so bad? Do you think it's just a temporary, like you said, knee-jerk reaction? You think things will stabilize and markets will digest it overnight today and be done with it?
Possible. See, but we have to be, prepared for the fact that central banks around the world are taking away the punch bowl. The party has really ended in that sense. The era of easy money, has ended. At least for, I would say, for the next 12 months. If not for longer. So that is why the what we are seeing in the market is not, while the quantum of the fall might seem a little bit surprising. I don't think it is all that surprising also, because the inflation risks are building up. And as far as the timing is concerned, I just think that because by the end of the month, I think RBI has probably a clear picture of what the inflation print is going to be
Yeah.
like. And given the market expectations of the US Fed also looking to aggressively hike rates, I think they just didn't want to be perceived as being behind the curve. In fact, that is what some commentators had said after the last monetary policy meeting, when nothing much happened.
What happened to banks now? They were already underperforming. Today, we've seen, all of us have seen what happened with Bank Nifty and all of the listed banks. Cost of funding will go up, obviously. Cost of lending will also go up as well as a result of that. So, what happens to the fundamentals or the performances of these banks over the next few quarters when we are expecting that, yes, gradually the rate of interest will only hike from here?
See, at least over the next few quarters, I don't see fundamentally anything much changing for banks, because see, some banks had already started increasing deposit rates and also lending rates in anticipation of this move. It is not, and typically these kind of rate hikes, the effect happens with a little bit of a lag. And while there have been certain stresses that have been building up in the system, like in terms of more retail loans going up, etc., I don't think immediately there is going to be any danger to financial stability.
And I know, Ravi, you don't track personal finance per se, but I'm sure many of our viewers who are watching us right now, one of the big questions in their mind would be what to do with their home loan and with the several other loans that they may have on their portfolio. Should they prepay it all and get out of the system before the rates are hiked further because they're all floating rates, or should they stay put and it's not going to be all that bad, in the big picture?
See, it is very difficult to say because rates are going to go up, and most
Yeah.
of our home loans are now linked to external benchmarks. There are external benchmark linked home loans, or it is based on the marginal cost of lending rates (MCLR), and it is going to go up. Of course, people have the option of extending the tenure of their loans instead of paying a higher EMI. Maybe they will exercise that, and whether prepayment or not, I would suggest that people speak to their financial advisors before taking a call on that.
But more important, it is to not get impulsive and not take any decision in haste, whether it's their equity investments at this juncture or their debt. But Ravi, just one last question. Now everybody will be closely watching out for the Federal Reserve's commentary as well tonight. And yes, we're factoring in a 50 basis points rate hike. But if, let's say, if that does happen, or if something more happens, more than a 50 basis points hike as well, if there's this negative surprise there as well, how will Indian markets and investors digest that tomorrow? Could there be some more pain for stabilizing and settling down and making peace with it?
While see 50 basis points is the consensus, I think there is a section that believes that the Fed could go in for 75 bips also. So essentially, what happens when the US Fed raises interest rates is that the dollar becomes stronger, and foreign investors would sort of prefer to take some money out of emerging markets and keep it in the relative safety of the developed markets, because of the yield differential going up, etc. So that is why the the RBI has also kind of preempted, a June rate hike by going for it right away, so that the the interest rate, the yield differential does not get out of hand. Typically, when the Fed hikes rates by quite a lot, that is negative for Indian market. But then we will also have to see, basically, what are the other factors, how is the growth momentum in India, for example. What are the chances of other sources of funds remaining stable, and so on. So
Yeah.
it is something which we'll have to monitor a little bit more closely.
The RBI governor said that he wants to that the monetary policy action is aimed at containing inflation spike and re-anchoring inflation expectations. So, with today's move, do you think? I mean, it's a move in the right direction to help curb inflation and the way we are headed. Because even the governor has flagged off real concerns about inflation and the levels at which we're currently at.
Yeah, so what he meant by re-anchoring inflation expectations is this. See, right now, most of this inflation is on the supply side, right? There are
Hmm.
crunches, and that is the reason why, prices of many goods are going up. Uh, there is only so much monetary policy can do,
Yeah.
to address that point of inflation. But what the RBI is afraid is that when people see prices rising, they expect inflation to go up. That is where we talk about inflation expectations, and then that can feed into the wages. They will be demanding more wages and salaries, which can lead on to an inflationary spiral. So basically, it is to preempt that. That is why the governor talked about anchoring inflation expectations. So that they also don't go out of hand and lead to a spiral later, inflationary spiral later.
Oh, all right, makes sense. Thanks, Ravi, for joining in and for putting things in perspective. RBI definitely has stunned the market today. Let's see what Fed Reserve has to do. We'll find out tomorrow, and we'll be back with more updates and more analysis of all the developments. Thank you to all our viewers as well for tuning in.
Thanks.